I want to welcome our panelists, Greg, Ben, Javier, and David, who's sitting in for last-minute cancellation, our esteemed host. I'm Nisa, Amoils. I am a venture capital investor, securities lawyer. I've been investing in this space for the past several years. Very excited about this event and the turnout. I want to thank David for putting it together. And I want to ask our panelists to introduce themselves. So, Greg.
Good morning. My name is Greg Landegger. We're a single-family office. We invest in all types of assets, but we do spend a lot of time looking at new technologies like Bitcoin and blockchain. Made our first investment in the space in 2014. And since then, we've made now over 25 equity investments in the space and still manage a much smaller digital asset portfolio.
My name is Benjamin Bronfman. I have a company called DGH, which was backed by my family office. My family office is kind of really focused on some niche industries, particularly atmospheric carbon capture. So there are 3 companies in the world that take carbon out of the atmosphere. We've developed that technology over 12 years. Then did some focused work on medical cannabis. We've invested in that and are doing quite well. And then are also starting to evaluate the opportunity in the blockchain and digital currency space.
I am Javier Rodriguez. I work at a US-based single-family office, and we came to the sector about 5 years ago as well, since our background was mainly in emerging market equities. So the digital gold thesis was what got us interested first.
Well, you all should know me by now, I hope. David Nage. Prior to joining Arca, I was in the family office world for about 10 years. My crypto journey started around 2015. At that point in time, a family member had made an investment in a crypto fund focused on Bitcoin. Around that time, there were some fairly negative headlines around things called the Silk Road, which were problematic. And so out of caution, I started to teach myself everything I could about Bitcoin and realized that it was something revolutionary, and that the way that our society works, our economic systems work, could potentially be disrupted and changed dramatically. Over the course of the last 30 years, I've made many investments in this space. I actually taught myself also how to code. That is not necessary, don't worry. But it is a good course to learn proper diligence on what is real and what is not real. Unfortunately, in the last few years, especially in 2017 into 18, we saw things that were not necessarily real. But there are things that are happening now over the course of the last 6 to 8 months that are incredibly real. Steve from Galaxy said the real. I agree with that sentiment. And so I'm happy to be here and filling in and talking more about how family offices perceive the space.
Great. So on the last panel and this morning, we mostly focused on liquid investments. And I wanted to talk more about some of the illiquid investments. And some of us were here 6 months ago at the first event. And we took a poll then about where families are investing capital. So I wanted to ask each of you, where are you investing now, and how much of your portfolio are you allocating towards this asset class?
So we think the whole story has changed. We're past the get rich quick in crypto story. If you look at family offices, if 17 was crypto, 18's about cannabis, and 19's about opportunity zones. So we're now focusing all over. We really have been focusing our efforts on building businesses, and that's where we see most people. Can you speak into the mic? Because there's a lot of great opportunities. There's a lot of great opportunities right now to invest in the space itself. Lots of companies are raising money. And fortunately, there are not a lot of people investing. You talk about a lot of people will throw out these numbers, how much is being raised now, but I'll tell you over the past 6 months, with a couple of exceptions, most of the deals we've either seen or invested in have not even reached the amount of money they're looking to raise. So, if you want to build businesses, this is a great opportunity to build business in companies that are looking to grow, and they have found blockchain primarily as a technology to help them improve their business structure.
Yeah, I think it's important from a family office perspective to kind of look at this as building a business. If you believe in this sector, and we haven't made an investment yet, but for example, atmospheric carbon capture, the values in that space are about to fundamentally change, and it took 12 years of research. That's my lighting, I requested that. I also have intro music, which David didn't play. But that was 10 years of research into an industry that was now recently mentioned by Bill Gates as a new industry that is going to change the world. He put out a list with MIT Technology Review. Medical cannabis, same thing, started researching it 2010, started a company in 2015. 24 months ago in medical cannabis, the largest single check that was being written was a $250 million check. Today it's $4 billion. So, when something fundamentally changes, it really changes. So you want to get out ahead of an opportunity like that and do your research and have a real thesis.
Yeah, we haven't focused too much on the illiquid side yet, at least not aggressively, in part because our background's on the liquid side. And in part because with all the comparisons to internet in 1994, it seems like that would have been too early for a lot of picking winners in 94 in the internet was tough to do. I certainly wouldn't have been able to pick Amazon then. And so in that sense, again, not being a VC by background, it feels a little early to be picking winners in a number of the areas that have great long-term potential. That said, I think there are some areas, enterprise applications could be a good but very unsexy example of a segment that is more ready for real adoption. Everyone 10 years ago talked about the electric vehicle as being an eventuality, and it was, and it is, but for a decade or so, the Toyota Prius was a great, had a lot of unit sales, and so similarly, enterprise blockchain kind of hybrid business could be a great segment to invest in for a little while.
So let's go into a little history. First and foremost, this is not a new technology. Anyone who has spent time in here will go back and look into articles written by people like David Chaum from 1982 writing about mixed tables. People will also search out and read articles from Nick Szabo about smart contracts in 1997. These are all things that we talk about daily now, but these are things that have been iterated academically and in many cases at a commercial level for over 30 years. And so first and foremost, I like to demystify that from talking to my peers about what's happening within digital assets and blockchain. Secondly, in terms of allocations, there are people out there that are saying 5% of assets. No, that is not appropriate sizing for this market right now. To the point of what Javier just said in terms of maturation of cycle, are we in 94 or are we somewhere in the early 90s? The way I like to look at it, does anyone remember ISP? Trying to put in an ISP address instead of a web address like Amazon.com. Most of you don't. But back in the day, to be able to get to Amazon.com, you would have to put a chain of numbers in there to get to Amazon.com. And that was the difference between ISP to DNS. And that's my opinion right now, is that we are in this phase where we're moving from ISP to DNS. UI and UX 2 years ago did not exist. Now you have things that are popping up. One of the cases I like to look at is something called Dharma. Dharma lets you use Ethereum, which is one of the second most used cryptocurrencies out there, and Maker, which has a cryptocurrency called DAI, and you can create collateralized loans. And the user interface on that, you go on Dharma's website, within 5 minutes you've created a loan, you have APR that is given to you, it's a 30-day loan, it takes 5 minutes. That 2 years ago did not exist. So the way I like to say things is that effectively, the cart was put before the horse 2 years ago. There was a lot of interest in the asset class in 2017. Anyone at Coinbase, and Linda will be talking later, she was there on the front lines. The infrastructure just was not there in 2017. It was all manual processes. But there was a ton of interest because, in my opinion, the retail investor was missing out on the equity bull market for the last 10 years. And so you had a tremendous amount of activity, you had a tremendous amount of interest, you had a market cap that shot up to $850 billion, but the infrastructure, the pipes, the data transparency were not there. However, what's happened over the last 6 to 8 months is that those infrastructure pieces have been starting to be built. And those are places where you can invest in equity into those companies that are much more traditional venture capital investments. That accompanies your liquid market exposure, which in my point of view, if you have $500 million as a family office and you're putting 10% of that into the market every year in an alternative, more endowment style model, I think if you were able to extrapolate 1% of that $50 million and start dipping your toes into the ecosystem to see what's happening, get exposure to deals that are being presented, I think that is more of an appropriate sizing in today's market.
Great. So on that note, how do families get exposure to some of these deals? I know, Greg, you've invested directly and also in funds. What's your view on using a fund manager who's doing this day in and day out, as most families may not have access to some of these deals directly?
I think you just said it. I mean, family offices can do funny things. My cousin who's in the back and I have spent 5 years primarily doing nothing but this, and it's been great. Most offices can't, tolerate that insanity probably. So the way families are getting in is through funds. And there's some very good funds. They've raised money recently. It gives you the diversification you're looking for in the space, and it'll also give you the education. We were lucky. Originally, when we got in, one of our first investments was in Digital Currency Group, which is an equity investment. But one of our thesis investing with them is it was probably a bigger investment than we should have made, but we said if we fail, we'll at least learn a hell of a lot, and it's turned out well. And you heard everyone on the panel this morning. Education's a major issue. People are looking to invest, obviously to get a return, but also to learn what's going on in the ecosystem.
Yeah, same here. I think, you want to allocate to our funds, you get education. Our family office is a little bit different because we kind of launch specific products or investment programs, and then we kind of go out and raise on the back of it. So we kind of have a slightly different approach, and we'll spend a lot of time doing research. But the Digital Currency Group, we were speaking to them, when that deal was going around, and it's been a great platform investment.
Just to tap into that, so give you kind of a perspective of the market right now, there are over 500 funds that focus on digital assets and blockchain and crypto. In 17, there was 50, give or take. So you've seen a 10x multiplier in the last 2 years in funds. And as my partner and colleague Rain mentioned, for a family office that's trying to dip their toes into this, trying to do diligence on a fund manager that's focusing on crypto these days is not easy. There are many issues, especially operational security, that you have to be very aware of. How are they actually custodying these assets if they are liquidly traded? How are they managing, key man risk and things of that nature? We've had some unfortunate situations where people hold large amounts of crypto, case in point Quadriga, and they apparently go to India and die and eviscerate 190 some odd $1 million of investors' monies. That is not acceptable. But again, there are people out there that are using institutional grade infrastructure and back office processes to do good investments in the space. So that's one way they can tap into the market, is vis-a-vis funds or vis-a-vis fund of funds. Doing direct investments in this space right now is not easy. Most family offices, I know this because I spent a lot of time doing this, a direct investment into the asset space right now is hard because of valuation. how do you actually mark to market what this thing is valued? How do you actually know what the network is going to accrue? Network accrual is something that's very difficult to do right now because a lot of these networks and protocols don't have a lot of users on there. So it's a lot of future kind of projections and what ifs. People also try to do relative valuation. Well, if this protocol is able to capture 10% of Facebook's value in 10 years and it's going to be worth X, that doesn't really work. So valuation in terms of doing direct investments in crypto assets and digital assets is not easy. And so you really need to work with people that are spending 24/7, 365 in this space to be able to get access to those kind of opportunities, and they do exist. Bakkt, for instance, just raised $182 million over about 2 months ago, and from some very key family offices. There are significant checks out there that are happening into the space, into the infrastructure, that are coming directly from family offices. So they can be done. They do exist. It's just that you really need to work with people that are dedicated to this, as I said, full time.
So on that note, and back to the timing question, wouldn't you think that normally in venture, you invest in a bear market, turns out to be the best vintage year. So applying traditional venture lens onto this asset class, because a lot of the companies are raising in equity, not tokens now. How do you evaluate that from timing perspective?
So we think it's a great time to invest now because the hype's gone. I mean, there was a time a few years ago where we would literally get a call from a company saying, are we interested? We'd get a deck that within 5 minutes and have to make a decision in less than 5 hours. And we had no access to management, and frankly, the deck didn't say anything. It was a white paper that sort of had a lot of bullshit in it. Now, there is due diligence, and now it's the venture capital space built around a new technology. That's how we're really seeing it. So, again, people are looking for money. There are great opportunities. There's been a lot of de-risking. You're not going to, there's some seed rounds, but now you're in a lot of A and B rounds, but you can see companies with revenue, with business plans. There's this term cash flow. People don't use in crypto. You can see cash flow in companies. There's a real story to be shown here now.
Yeah, I think, you can either try to invest in the market and just play the kind of, just the almost like Ethereum or Bitcoin, whatever is actually physically trading out there. Or you can invest in the venture side, which is an equity investment, and obviously that's a more long-term type of investment.
Yeah, the exciting part about blockchain technology is it's so transformational that there should be several waves of different investment over time that work. So as it relates to timing, I think the most important thing is to know which wave or segment of the market you want to focus on. In the internet, you had a hardware wave, and then you had e-commerce, you had advertising, you had social media, things that couldn't even have been conceived of at the beginning of the whole process. And blockchain will serve up similar waves. So the timing of which is different in every case.
Just to add to that, so my friend Ariana is here, and we've talked about this extensively in terms of CryptoKitties being kind of one of the first kind of use cases, or not necessarily use cases, but something that brought a lot of people to the market. And so there's been this discussion, do we need to have infrastructure first? Do we need to invest in equity into platforms and pipes that are creating infrastructure for the ecosystem, or do we need to have something that gets everyone excited? And so, as we saw with CryptoKitties, that was something that got a lot of people excited. It's a non-fungible token. If anyone knows anything about, some of the gaming that are happening out there, Fortnite, I've got 2 kids. Apparently, Fortnite is a big deal. I just figured that out. Everyone else knows about it, apparently. 185 million people use that, kids and people, adults. 21% of that 185 million population are in the age of 13 to 18. So you have roughly about 30-odd million people, kids, that are using Fortnite. And if you ask them, Tom Shaughnessy from Delphi is here. He did something recently where he talked to a few of these kids, and he said, well, here's $20 in USD, or what if I give you $20 in something called V-Bucks, which is apparently native currency on Fortnite. And it seemed that most of them wanted the digital native currency for Fortnite instead of the USD. So you have these populations coming into the space that use these types of currencies already and are starting to get very excited about them. And so in terms of timing, I say in the next 5 to 10 years, you're going to see more of those populations and demographics coming into the market that are used to digitally native currencies, that are used to the notion of a non-fungible token, which we can talk about more later. And so, that's where my timing is. I'm looking forward instead of looking back per se. And lastly, in terms of, kind of the deals that are out there, some of the companies out there, again, like I mentioned, raised $182 million. But some of these other teams are backed by Union Square Ventures, are backed by Peter Thiel, have teams that are from Goldman Sachs and from Virtu Finance, and are from some of the largest institutions that we know today that are actually building. I like to think of it, and I don't know if Tom is here, but the COO of Bridgewater, obviously one of the most successful hedge funds in the world in history. The COO of Bridgewater recently left Bridgewater to go to True Digital, which is a cryptocurrency focused company and exchange. I mean, those types of things happening in the market are happening in real time today, and those opportunities are existent.
There's no shortage of talent coming into the space. We know that. Not necessarily reflect what the public markets are doing. Gaming is a really exciting area because there's no infrastructure barriers, the consumer behavior is already there, and I think we will see in the next few years a lot of exciting consumer adoption in that space. What are some of the obstacles that you're still seeing in terms of the other use cases, like efficient capital formation or putting a digital wrapper on some of the private placements? Is this really the year of security tokens? How much do you consider regulatory changes or lack thereof in your investment decisions?
Regulatory is huge, obviously. So with cryptocurrency, obviously, or digital currency, there's tons of headline risk. Our family office has done something else, which is cannabis, which has had a lot of headline risk. In that investment, we spent 5 years working to change medical cannabis laws in states by working with nonprofit organizations that were changing those laws. Americans for Safe Access, Students for Sensible Drug Policy, understanding what it took from a regulatory perspective to change and open up a market that then you knew was going to be a great investment. With digital currency, there's still a bunch of headline risk, but regulations are huge. You don't want to be a family office and you're breaking federal law, you're committing, securities fraud. I mean, these are major issues. I think, the way that we think about things is, we look at something like digital currency and we say, well, what are the barriers right now to having, digital currencies work? So utility is a big one. Right now these things are traded, but they're not really used. That's a big difference. And then what else can it be used for? So when you look at Gen Z and you look at some of the use case scenarios where digital currency is going to lift off, you think about the environment and other things that market sector cares about, and then you try to go and understand what's happening in that field. So we've looked a lot about this idea about digital currency is the new gold-backed currency. For us, being in the CO2 industry, we're looking a lot at how can CO2 a potential backer of digital currencies. We might build a whole strategy focused on that, for example, which also has a lot of regulatory changes happening. California carbon credits. It's a massive regulatory shift in that field.
Yeah, a lot of people talk about regulation and about building out more robust layers of institutional level infrastructure for all the obvious reasons. Those are constraints, but I think it still comes down to education, because even if you flip the switch and a lot of people were able to invest or have more clarity on the regulatory front, there's still a long way to go in terms of getting investors comfortable with the space, and that was touched on this morning, but one thought I've been having recently is that the space talks a lot about how blockchain is different than everything that's come before, and it's so different and transformational. But maybe it's worth emphasizing the degree to which a number of these investment areas are similar to areas in which we've all invested in the past. Bitcoin is a newer version of gold, right? The smart contract platforms share some similarities with tech platforms that we all know and use every day. And you could start with that and then explain how they're different. The enterprise and decentralized apps that are being built are VC investments. We've all made VC investments before. And so, in a way, investors may need to get to a place where they see that this isn't a bridge too far or isn't crazy different than anything they've done in the past. Maybe that makes the space feel more approachable. And in the meantime, there's a whole lot of career risk associated with this, because if you're pitching one of these investments, it better work. If you're part of a large institution, you're going to get what? Personally, 1-2% of the upside if it works. You're going to get 100% of the downside if it doesn't, because you're going to lose your job. So that's still where we are education-wise.
In terms of security tokens, in terms of other ways of using distributed ledger technology and blockchain, as Nisa alluded to, how many of you out there have made an investment in a GP and have been in a 5 to 7 year lockup? Just a quick show of hands. Yeah. And imagine if you had the ability, whereas you needed to actually get liquidity in about year 4 or 5, you had the ability to not necessarily use a secondary broker, but use the ability, you can actually have that as a liquid token and be able to have that liquidity without having that broker. And we all know that secondary brokers have an amazing capacity to take advantage of the fact that they're one of a few sect of people that can actually give you liquidity when you want it. And so the spreads there are not very fair to you if you're looking for that liquidity position. And so, it is feasible, whereas there are funds out there that have already started to iterate around this, where you can have a fund, you can have a GP that is tokenized, and effectively the investor would be able to have liquidity on an exchange. Now the infrastructure, getting back to the infrastructure on trading those tokens, is evolving. There are a few players in the space. The Pallotta family have helped back something called Templum. There are other institutions. David Sachs and his family office have helped build something called Harbor. There are institutions that are being backed by family offices and high net worth individuals to create liquidity pools, so you can actually start using these apparatus, these tools. But we're probably about a year and a half to 2 years away from that. But imagine you have the ability to have liquidity without having to go to a secondary broker. That could be potentially very, very accretive to all of us in the space.
Right, and it's not just funds, it's other real assets as well. So some of what we've already seen in that space has been real estate and art and securitized debt and rare gems or barrels of oil. So which asset class, because we don't think we should tokenize everything, but which asset class do you think we should be focusing on, or we'll see some of these exciting projects come first?
For me, it's, again, I was mentioning it before, it's carbon dioxide. I mean, when you look at, the true cost of climate change, the environmental externalities, how great those are, and then you look at, the reasons why people talk about gold being a great investment in a recession. Well, if you think about, risk for the global economy, climate change presents any myriad numbers of fantastic and really expensive risks to basic assets like real estate and health. So we are spending a lot of time focusing on the intersection of, carbon dioxide as a backing for a digital asset. And it's great to see these digital assets now getting backed by real estate or other real assets. I find that to be an interesting evolution.
the one area we're looking at right now that we're really excited about is gaming, because gaming is sort of, the meeting point between digital currencies, pop culture, and everything else. But I remember when Bitcoin got, tracking, someone showed a chart, I guess Gabor did earlier, on how many wallets there were. There are 50 odd million Bitcoin wallets, and I think that's a great number. I'm excited about it. But there are 2.6 billion people who spend an average of 30 minutes a day playing video games. That's an unheard of metric for me. I mean, I can't even comprehend that still. So,
Come to my house, there's a lot more.
Native currencies, which are derived from Bitcoin. When you get into the ERC 721 token, which is going to allow people, I'm one of these fathers who do spend it. I spend more money probably on V-Blocks than I do Bitcoin right now. And you buy V-Blocks, your kid buys a skin, and you can't do anything with it. The only way we can trade it is we can actually sell his username, and someone can buy that. Well, now there's technology coming out. There's a raise that was completed about a week ago where people are building an engine for scarcity to allow people to trade these skins on a blockchain. It's great where we're going right now.
Yeah, I definitely see that happening too. And one of the questions, obviously I have to wear two hats here. I'm panelist, I'm filling in, I'm also helping you guys with questions that are coming in. So one of the questions that came in is around the narrative of blockchain, not Bitcoin. Of the people here, how many people would say they're more excited about blockchain versus Bitcoin? Right. And so there's an interesting conversation, waving your hand very profusely there, I see. And so there is this notion, I want to address this, I think it's interesting from a family office perspective. Again, in terms of education, there's this notion of, I like blockchain technology, but I don't like the cryptocurrency, I don't like Bitcoin. And where we need to start to get to is an understanding of what a blockchain is versus what more of just a MySQL is. What a database is that might be in the cloud. A private blockchain is something that, for instance, JP Morgan is using now. It is more of an intranet versus an internet. It allows them to have their own validators. This is a phrase, basically just think of someone who can say, yes, this is a transaction that happened. Yes, this instance just happened. It's a validator that they have basically ability to hand select. So there is the notion of a private blockchain versus a public blockchain. You're seeing institutions using private blockchains because they have fears of their trade secrets and other things that are very important to them getting out there in the public. And so there's this idea of how do I distinguish that? Where is the value? When you have a private blockchain, the issues reside there are things like attack vectors. If you have 10 people who are validators, they can be known. Or if you have a public blockchain where you have 10,000 validators, trying to take down that network becomes increasingly hard. So the notion between private and public blockchains becomes also a security issue. And so again, with the education, I think we need to realize that there is a difference between private and public blockchains. What's happening on things like NFTs, non-fungible tokens, and ERC 721, which is Ethereum, that is more on the public side. And so, anyone who's looking to understand that better, feel free to reach out to me or anybody else, because there is a very big distinguishing factor that needs to be understood at a higher level. And with that, does anyone have any questions? I'll take a few. We have, sure. You can scream it out if you'd like.
So, my name is Peter Lyons. I'm with Common Capital. My question was to the point that was made about liquidity. If you're investing in a GP and you want liquidity, do you necessarily need to sell to have that liquidity, or if you're looking for collateralizing it and taking some sort of loan on that? Is that something you guys see as a sort of application of liquidity rather than necessarily trading on ATSs, or is it both?
Well, I know that Blackstone, I think, just did $1 billion fund, which is a collateralized fund obligation. And so we are seeing that happen in the market. It's not appropriate for me to say if that is a positive or a negative. But I think what we've seen with collateralization and when we've seen with synthetics and we've seen with CDS and mortgage-backed securities for the last 10 years, we haven't seen very good things with that. I think if you have the ability to have more ownership of your assets personally, and you can actually do things with them without having to go through an intermediary, I think that is better for the investor. And so, yeah, we are starting to see some of those opportunities arise. But I think, as I said, giving the ability to have liquidity for the investor and having them be able to dictate that, I think is a better thing.
Yeah, I think that's a more exciting story for us, at least. I mean, we invest in a lot of funds, and we can get out of any fund we want to, but the minute we call up the manager, we've got this flashing light that says discount right behind our head. I mean, there's certain funds we've told the managers we'll buy anyone's, partnerships at 80 cents on the dollar at any time. And so you're going to have the first time here. And David said we're a year away. I think we're longer than that, but if you have the ability at any time to trade out of any partnership, I mean, I think everything will be tokenized eventually, and that's where we're going with it. It's more exciting, but lending is getting very big. We don't lend our Bitcoin. You can get paid 6% on it. It's not worth the risk, which sounds crazy, because normally 6% return I'd be very happy with, but in Bitcoin, we just don't do it. But those markets are all developing very actively right now.
There are also at least 2 examples in Europe, I think, of funds that were raised with a crowd-funded tranche that was then tokenized, and so you could trade out and gain liquidity through that tranche. But that's new.
And we have one more question before the family office. Sorry, Harry, we'll get to you sometime soon. An interesting question. As a family office, what types of funds should we have exposure to? What types of strategies do you gravitate towards? I'm sure Greg can also answer this question too, because you've had exposure to the fund level. But there are, as I said, about 500 different funds within crypto assets today. Roughly 85% of them gravitate towards more liquid strategies. And then about 15, maybe 10 or 15% of them gravitate towards traditional venture capital investments. And so within the liquid side, you are starting to see some interesting things like stat arb and more algorithmic trading. You also definitely need to look into managers who are doing fundamental intrinsic work. Yes, you can do fundamental intrinsic work within the asset space. You can look and see what projects are being developed. You can see the dev community. You can look at the Git repository. You can do your homework, and you can get very smart about these projects very quickly as a fund manager. And so there are definitely ways, there are different strategies that are being deployed. But as I said, roughly about 85-15 right now in terms of liquid versus VC strategies.
One fund, we're not invested in it. He doesn't know how to say it. Mitchell Dong, right here in the front, he's got a great fund. I mean, there are traditional investors who have come up with funds, and you can really very quickly.
Are you giving away Bitcoin too?
Diligence. One manager once told me when we asked about risk management, he was like, "What do you mean?" And we said, "Okay, are you holding any cash in a neutral position?" And his exact quote was, "Dude, we're all in Bitcoin." That's great, but for due diligence, that's not the answer I was looking for.
So with that, again, I have to wear 2 hats. I want to thank everyone for joining us on this panel. Thank you, Nisa, Greg, Ben, Javier. Our next panel is going to start in a few minutes.